Hi, my name is Rod Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I am thrilled that you're here. And I know you'll get a lot of valuable information from the gentleman that we're interviewing today. His name's Dave Foster. He's been around a long time in the real estate space, and specifically in the 1031 exchange space. And so excited to give you guys an education. If you don't, we'll kind of drill down a little bit. We'll start with some basics, but we'll kind of dig into how to best utilize 1031s. Well, welcome to the show, Dave.
Hey, Rod, thanks. It's great to be here. And in one sentence, you just made me feel really old. I've been around a long time.
And you've definitely got a voice for radio, brother. You like that gravelly Wolfman Jack voice. Anyway, so
I think I've got a face for radio too. But that's
okay. Well, me too. Yeah, me too. Yeah, funny. Give us a little bit of your story. I know you're a 1031 intermediary. Your website's the 1031investor.com. So talk about a little bit about how you got into this business. And
yeah, you know what? I think probably that we take a little time trip back to when I was just starting my real estate investing career, and probably the same as you and the same as most people around. You end up getting this niggling idea that, hey, maybe real estate investing is a good idea. And so what we did, my wife and I were both on fairly high profile corporate careers. And we said, we want to get out of here because we had our first child. And I swear to gosh, when that baby comes, you want to throw your TV out the window because you just want to sit there and look at that little kid. And we said, why do we want to waste time working at careers when we could be spending time with our children as they come? So we started to look for avenues for developing the cash flow that was going to allow us to slow down and take that exit ramp. Same story as a whole lot of people today. Well, we hit on real estate. So like everybody, I just dove right in. I bought a duplex in Denver, fixed it up, sold it, was feeling fat and sassy, baby. All right. Just because that Denver is my stomping ground. What street was it on? Where was it? Tell me where it was. It was right across the street from Sloan's Lake.
Oh, no kidding.
If you know Denver.
Right off Sheridan and 26th.
That's exactly right. Yeah, this one's like 38.
Oh, that's so funny. I can still name every street between Kipling and Havana because I had houses on most of them. But anyway, please continue. So
yeah, well, you know what's really sad is what area. I bought it for and what it's worth now.
Oh,
I probably should have gone to it.
Don't get me started. Don't get me started on that. Good Lord.
Who knew,
I had 500 houses there, and if I still had them, they'd be free and clear. And I'd be netting, I don't know, somewhere between 500, 600,000 a month right now. But anyway,
you and me both, brother.
Woulda, coulda, shoulda.
You and me both.
Yeah.
Well, so I was feeling great about that, right? And then I went to my accountant, Turbo Andy, at the end of the year. And like every accountant, and because I am one, I can poke fun at us, but like every accountant, they're great at telling you about the pothole you stepped in last week. Man, if you would have done that different, And I didn't, it was at that moment that I realized that I had a silent partner whose name was Uncle Sam. And he was actually going to make more money off this deal than I did. So that all of a sudden stopped looking like such a great deal. But this was 1996, Rod. You'll remember what happened. Well, you won't because you're so much younger. But what happened right at that moment.
That's really funny. In 96 is when I had 500 houses in Denver. But anyway, please, I'm 60. I may look young, but I'm not. I'm old as dirt.
So,
anyway.
Yeah. So 1996, there was a huge court case that was settled over 1031 exchanges. And they went from being this hoodoo voodoo, attorneyed up kind of process to being something that normal, average American investors could use. And I had some really good friends in Denver at that time. And, you can, Rod, you know what it is? The marker of a really good friend is what? Those are the people that feel like they can mock you mercilessly. So they laughed at me and said, by the way, Dave, we're going to start a business to do these things for people so that they won't have to pay tax on profit like you're having to do. I said, count me in. And that began the 20 plus year journey of not only doing 1031 exchanges for myself to get us to our goals, but also to help others do 1031 exchanges so that they don't have to pay tax on the profits from their real estate sales.
You know, what's interesting, buddy, we were talking about how we were arguing who had the worst memory, but I swear I've heard you speak before, and I'll bet you it was in Denver, or at a meetup or something, because your name now is starting to ding with me a little bit. Anyway, I digress. But
as long as it was not at a post office, I'm okay.
Right. So let's do a real quick high level basics of a 1031 with the timelines and the requirements and what you can and can't do. I don't spend a lot of time on it, but just for those that haven't really got a clue what's involved. So let's do that.
Right. So the whole goal of the 1031 is to sell a piece of investment real estate that you've either have highly appreciated or you have depreciated highly, and you're going to sell that and purchase new investment real estate. That's really the simplicity of the process. But inside of that are those components that have to be there, and they all have to be there present at every time. Someone like myself, a qualified intermediary, has to be a third party there in addition to the process. And they monitor the process, document the process, and help you stay straight of all the statutes. So you use a qualified intermediary. From the date of your sale, you get another 45 days to identify your potential replacements. You've got a total of 180 days to close. So right there, you see the IRS they were ticked off that they lost the lawsuit. So they tried not to make it easy. Simple as that. But you've got the time frames. What you're looking to do is purchase at least as much real estate as you sold, using all of your proceeds to do that. Now, the nice thing about that is that it does not have to be one for one. The number of pieces of real estate doesn't matter. And that's where a lot of our clients can get very strategic as they go through their careers. Because we've all seen in our careers periods where we want to expand, periods where we want to contract, periods where we want to change the class or sector or demographics of where we're investing. The 1031 doesn't care about that at all. So you can go anywhere, you can buy anything as long as it's investment, you can buy any number. The key is that it's investment property for investment property. And then there's some issues that the taxpayer has to be the same on either side. But in a nutshell, that's it. But it all starts with that first criteria, which is get the QI involved. They have to be involved prior to the sale. And your QI should be your guide through the mines of Moria and to finishing that 1031.
So, I know, I don't know if it's not the recent past, but I know there have been horror stories about, because the money goes into a bank account and the people have ran off with the money. Is that, where QIs have been fraudulent? I'm assuming it hasn't happened in a long time, but I don't know.
Yeah, I was going to say, like every 6 to 10 years, some idiot goes off the reservation and takes the money. The reason for that is that the IRS is much more concerned that the investor is going to do something nefarious than they are concerned that the QI is going to. So they don't let the investor have constructive or actual receipt. So what happens is these QIs get massive amounts of money sitting in their escrow accounts, and
occasionally drugs, whatever, they lose it. Okay.
Whatever it is, yeah.
We won't waste any more time there, but I just, think it's triggering some memory for me.
Yeah, it is. Well, there's a real easy fix that'll take 30 seconds to tell you about.
Okay.
You want to make sure that your QI is keeping segregated FDIC insured accounts that simply are in your name and in the name of the QI. And as long as those are dual signatory, money's never going to move from that account.
You're allowed to be a signatory on the account.
Exactly.
Okay.
So you've got an element of control, but not so much that the IRS is worried.
That's protection for sure. Okay. So talk about you just went through the requirements. Yes, I think you just went through the requirements.
That's not all of them, yeah.
Yeah. Talk about, we talked about this before we started recording, how people will start Well, actually, let's go here first. Let's talk about bonus depreciation first, because there's been some talk that in some cases, it may not be around much longer, but like this year, and I don't even know if it's still in play next year, but it might even be better than 1031 as a temporary solution. What's your comment on that?
Yeah, well, I think there's probably some truth in that.
Okay.
If you keep the word temporary
right
in the sentence,
right
because depreciation is this horrible, awful gift from the IRS that really isn't a gift. Because whenever you sell, you have to pay it back. So you get the tax break when you take it. And bonus depreciation is simply an acceleration for certain components of real estate that lets you take more than the normal amount of depreciation at the beginning. So at its end game, it simply means you're going to have to pay more back at the end. So do you get a temporary benefit? Absolutely.
Yeah.
And that's why people are saying, oh, it's better than the 1031. Here's where the 1031, though, outshines it. And that is that with the 1031, you're indefinitely deferring all depreciation. And if you play your cards right to the end, you're never paying it.
Right.
So do you need a temporary benefit for a huge windfall profit this year? Sure, bonus depreciation might be your friend.
Right.
Are you interested in maximizing the amount of deferred tax that you're getting to invest for yourself throughout your life? Then the 1031 is the way to go.
Yeah. And of course, if you never plan to ultimately sell that last property, what'd you call it? The 4Ds? Right.
Right.
Could you tell the audience what that means?
Yeah, we live by a mantra of the 4Ds: defer, 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 die. Because as long as when you do a 1031 exchange, as long as you own that replacement property, you'll never pay the tax. As long as any time you sell that property and do another 1031 exchange, you'll never pay the tax.
Right. So you can kick the can down the curb, just like our politicians are doing with our national debt. You can just keep kicking the can down the curb. But with this, there's not a horrible ending.
Well, the horrible part of the ending is you die.
Well, so
I don't recommend that. But here's what happens. When you die, your heirs inherit that property at what is called a step up in basis, which means the tax and depreciation go away. And it truly becomes a tax-free event.
Yeah, no, that's a beautiful thing. Yeah, in that regard. But you mentioned that people will start off with this 1031. And I guess I'm guilty of it myself. I did some 1031s and I ultimately sold those properties, which kind of defeats the purpose. Well, it kicks the can down the curb a little bit, but if you keep going into another 1031 property, you'll never pay that tax ultimately. Now are there any death related nuances as it relates to inheritance and things like that with the 1031 property?
Well, it's got to come into interplay, of course, with inheritance tax. But the first thing that happens is there's that step up in basis.
Okay.
So that's going to reduce the amount of the estate anyways. Okay. I would say, Rod, probably the biggest nuance is for you investors out there, be very careful about telling your children about this part of it.
Funny. Oh, that's funny. Okay. So are there any instances where you wouldn't want to do a 1031?
If you are looking to, well, you know what, you're kind of talking to the band leader here. Okay. Although, my brother, I, like you, am guilty also of having properties that I had 1031 and then ended up selling, and I didn't because I wanted to go into something that was a little more adrenaline filled. So for me, it was into land development. And 1031 exchanges are only for real estate that you have the intent of holding for productive use. So if your heart is really in the fix and flips, if your heart is in land development or construction where you're creating inventory, the 1031 is not going to be right for you.
Yeah.
But if you've got a longer term horizon, the beautiful thing that I've discovered now is that I can keep my creative energies going and still use the 1031. It just has slowed it down a little bit.
Okay.
For instance, we went from single family rentals into vacation rentals. We went from vacation rentals into commercial property. I ended up buying a property that I ended up turning into a major motion picture movie set. Those kinds of things all can be done within the 1031. And ultimately, now as we start to look at the next phase of our investing, we're 1031ing into more passive investments. Things like Delaware statutory trusts, triple net commercial properties, the things that take less activity. So there can always be reasons why you need cash. It happens. But as much as you can, like you said, kicking the can down the road. Every day you defer that tax is a day less that the government gets the money and a day more you get it to spend for yourself. And that's kind of the balance and the goal.
I mean, you can kick that can down the curb and refinance as well. So, you can pull money out. There are ways to get money out that are tax-free.
The refinance strategy is huge. Yeah. Absolutely.
Right. You can pull the money out tax deferred. I won't say tax-free, but at that moment it's tax-free. So what are some of the common mistakes you see people make or issues that pop up as it relates to 1031 exchanges?
Single biggest mistake is I still field maybe 2 or 3 calls a month where someone says, Dave, I've sold a property. I want to do a 1031 exchange.
Oh,
yikes. Now, I always have to ask, because if you're in the northeast part of the country, you typically say, I sold a property when you go into contract.
Right. You're going in escrow. Right.
That's okay. You've still got some chance.
Right.
But if you have actually closed escrow,
you're done.
You cannot do the 1031 exchange because the QI wasn't involved.
Okay.
Those are heartbreaking calls because they're so excited at what they're going to be able to do.
Right.
That's probably the biggest pitfall. The second biggest pitfall, I think, well, it's not a pitfall so much as it is confusion around reinvestment targets, because people think I only have to reinvest my profit. And so they're thinking in that terms. And what we have to tell them is that, remember your partner, Uncle Sam, they're leaving their tax in the game. They're expecting you to leave your money in the game. So any amount of cash you take out, you can do, but any amount of cash you take out or any amount of property you purchase less than what you sold, they're going to call profit. Now, people say, but Dave, I put $20,000 down on this. That's not taxable. And you're right. If you weren't doing a 1031 exchange, you wouldn't pay tax on that. But because you're doing the 1031 exchange and you're taking that, the IRS is saying, nope, that's not your original capital. It's profit. And we always remember who's got nuclear weapons and who wins those arguments.
Yes. They do have a pretty unlimited budget. So talk, you mentioned that you transitioned from much more active stuff to more passive investments, as a lot of people do as they age. What are the nuances of that as it relates to 1031 exchanges, if any?
You've got to be careful of the certain class of investments that you go into, because they do have to qualify as real estate and investment real estate. So for commercial properties, that's obviously fairly obvious. When it comes to the fractional passive world, there are a lot of people out there talking about this thing called the syndication. Now, syndications there's nothing wrong with them, but when you purchase an interest in a syndication, it's important to understand that in most cases, you're purchasing an interest in an entity, a partnership or an LLC that owns real estate. You're not actually purchasing the real estate itself. And so that does not qualify for 1031.
So we have done 1031s inside of our syndications, and we have to do what's called a TIC, a tenants in common structure.
Precisely.
Okay. Can you speak to the nuances of that?
Yeah, that's exactly right. Tenants in common means just that I am becoming an owner of the property along with you.
Right.
So I own a percentage of that property. You own a percentage of that property.
Right.
And that's what qualifies it for 1031.
Yeah. So you can do it, guys. Those of you listening, I mean, you can do it, but it's going to cost you a little more money for sure, because it's a little more structuring involved. It's a little bit of a hassle, but we've done it. It's not the end of the world. If you've got somebody putting a big chunk of your equity into the deal from a 1031, it can really help.
And you went the extra mile, Rod,
right,
to create the financing structure with yours.
Right.
That will qualify for that. That's a huge deal.
Yeah.
So many syndicators don't have that ability.
Yeah.
So
No, it's a nuanced thing. My partner Robert's really good at it, so it's not a big deal. So I'm not going to confess to be an expert in it, but I know we've done a couple already just in the last 18 months. So what haven't I asked you, buddy?
We were talking about transitioning.
Well, that's right. That's where we were.
The syndications. So TIC syndications are certainly one good way to do it. There is a critter called the Delaware Statutory Trust, which was blessed in 2006 or 4, where you're actually buying a membership in the trust, but because the IRS says it's real estate, so it qualifies for 1031. So those are types of things that you can do. Now, what we actually did is kind of an interesting story. We used conversions of investment property into primary residence to actually eliminate our tax burden as we went. So the two parts of the tax code that talk about investing in real estate are 121, which is your primary residence. Okay. And if you sell a house you own and you've lived in it for 2 out of the 5 years prior to sale, you get to take the first 250 or 500,000 if you're married in profit, tax-free. Mm-hmm. Now that's huge, tax-free, and you can do it every 2 years. The 1031 is sell investment property, buy investment property, indefinitely defer. Well, at the end of that, though, there is nothing wrong with you converting after you've demonstrated your intent to hold for investment, converting that into your primary residence.
So you rent it for a bit, and then you'll go live in it.
Precisely. And there's even a safe harbor from the IRS for this.
Wow.
In revenue procedure in 2008. So it's a perfectly legitimate process. What we did
hold on. Yeah. Let me just explain if that went over anybody's head. So you've got money that you've kicked down the curb, kicked down the can down the curb by doing one or more 1031s, and you decide to buy a house with your 1031 proceeds that you intend to use as an investment the day you buy it. So you rent it out. And I would not shirk on that probably. You probably can't play games with that. So you rent it for a year, let's say. But then if you decide to move into it, then it qualifies for that tax-free sale down the road. How does that impact the 1031 money?
Right. So since 2008, the IRS has tightened up a little bit of a loophole.
Okay.
So here are the rules now. If you want to then later sell that property that's now your primary residence,
yes,
and get some of the money tax-free, you must have owned it for 5 years.
Okay.
You must have lived in it for 2 out of the previous 5.
Okay.
And when you sell it, you'll have to recapture depreciation, and you will get a proration of the gain tax-free between the period when it was rented and the period when it was your primary residence. So buy a property, rent it for a couple or for a year, move into it for 4. Okay. When you sell it, did you own it for 5? Yep. Did you live in it for 2 out of 5? Yep. You get to take 80% or 4/5 of that gain tax-free.
Interesting.
We used it to move from Denver to Connecticut by doing 1031s into Connecticut ahead of our move. So that when we moved, we simply converted one of our rentals.
Wow.
And then we did the same thing to go from Connecticut to Florida.
Interesting.
And by doing that, we were able to pull out enough tax-free money that it bought the sailboat we lived on for 10 years with our boys.
No kidding. Wow.
So real estate profit, tax-free, bought a sailboat.
Nice. Love it. So what have I missed? Because again, I'm not going to confess to be an expert in this space. Is there anything you'd like to add to the conversation? You've added tremendous value already. Was there anything I missed asking you?
I think we've covered the nuts and bolts of the 1031
Okay.
pretty
Yeah.
well.
Yeah, I agree.
It's,
I agree.
The key is the guide.
Yeah.
Really, it's like everything else.
Yeah.
Folks come to you because you're a guide to helping them develop a lifetime cash flow. Folks need a QI that's going to guide them through that process.
Okay.
And when that's in there, you got smooth sailing.
Yep. Love it. Well, listen, Dave, thanks for being on the show. And I'm not kidding when I tell you, I'm pretty sure that we have crossed paths before, and I'm going to have to think about it some more. But I appreciate you coming on, my friend. It's a pleasure to, I think, reconnect. I really believe that. And I'm sure we'll cross paths again. Take care, buddy.
Great being here.
Thanks. See ya.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our Warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our Warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 41411. That's mentorwithrod.com or text CRUSH to 41411.